Welcome back to Thimbleberry U. I'm John Jagay. Amy Walls from Thimbleberry Financial joins me as always. Hello, Amy.
Hi, Jag.
Today we're talking about a topic that has not come up so far in our however many episodes of this podcast we've done. So I'm interested to talk to you about it. It's 83B elections. Sounds technical, but it can really have a big impact if you receive stock as part of your compensation. I know it comes up for people who work in tech or with the startup, one of your areas of specialty at Thimbleberry Financial. And a lot of folks don't even know they have this option. So I think you can anticipate my first question, Amy. What is an 83B election?
Well, Jag, I probably sound like I'm on repeat, but this is a very good question to start with. These aren't very common, and so it is important to address this. So an 83B election lets someone who is receiving stock, like a stock grant from their employer, choose to pay taxes earlier than when the stock vests. So they can pay taxes on the value of the stock at the time the grant is given to them, rather than waiting until it vests and it's technically theirs. For some people, this can be a smart move. So, for example, if the stock price goes up and they've taken the 83B election, they've already locked in a lower taxable value. Mm-hmm. If they don't file the election, taxes are based on the higher value, assuming the stock price went up, when the shares vest, which can lead to a much bigger tax bill. Okay. But this is an important part. It's not always the right choice. Right? As you've commented, my favorite words are it depends. It depends on if this is the right choice or not. And it's important to know that once the election's made, there's no reversing it. And those taxes have to be paid up front.
No take backsies. Got it.
Exactly.
Okay. All right. So let's try to crystallize this into a real world scenario. Say a client comes to you with a restricted stock award. How might this 83B election help them, Amy?
Let's talk about, of course, a hypothetical example. We'll call her Emily. She's a software engineer at a startup. Emily receives 10,000 shares of restricted stock as part of her compensation package. At the time the grant is made to her, each share is worth $1, meaning the total value of this package is $10,000.
Even I can do that math.
Okay, perfect. We're on the right track. So if she files for an 83B election, which her employer has to allow her to do, she's going to pay income tax on that $10,000 now. Mm-hmm. So if I'm Emily, I've just gotten this grant and I decide this is right for me, I'm going to do all the things to file this and I'm going to pay taxes on $10,000 of income now, even though the stock is not yet available to me.
Okay, that's an important distinction. Got it.
Yes, this is not technically my money because it hasn't vested. Mm-hmm. Now let's say that Emily stays with the company. And in 4 years, company's doing amazing. The shares are now worth $10 each, meaning her total stock package, assuming she hasn't sold any at this point, is worth $100,000.
Okay.
Because Emily filed the 83B election, she is not going to owe any additional income tax when the stock vests.
Okay.
And if she holds the stock, let's assume this wouldn't be the case, but that it all vests 100% in 4 years, as long as she holds it 1 year after that vest, she's also going to qualify for long-term capital gains rates.
And those rates are lower than ordinary income tax rates there.
Yes, but her ordinary income tax, rather than being $100,000, is $10,000, and she paid it 4 years earlier.
All right, so that does sound like a huge tax win. What would happen, Emily, if she didn't file this 83B election?
If Emily didn't file, in the example I just used where everything vests after 4 years, she'd owe income tax now, right, as everything vests. Mm-hmm. But that's not going to happen because everything doesn't vest 4 years later. So let's use a real-life example, and let's say Emily's in the 32% tax bracket, and her shares are vesting in equal portions over 4 years. So in year one, she received 2,500 shares, one quarter of the 10,000. And at that point, the stock was worth $5 a share, meaning in year one of vesting, she owes income tax on $12,500. $2,500 times $5 a share. Her income tax was $12,500 from these shares. She's going to owe income tax. Mm-hmm. Year two, because the stock is doing well, the value of the stock has climbed to $7 a share. So now there's 2,500 shares vesting at $7 a share. She's going to owe income tax on $17,500 in additional income year two.
Yeah.
So in year 2, the 2,500 shares that are vesting, because there's 4 years of equal vesting, are now worth $7 a share. So she's going to owe tax on $17,500 of additional income, 7 times 2,500.
Mm-hmm.
And if we move forward with this, by the end of 4 years, she will have paid taxes on over $50,000 in taxable income, compared to the example where she filed the 83B election and paid tax on $10,000 of income.
So by not filing, she's going to pay way more. She's paying income taxes on $50,000 versus the $10,000 she would have paid at the beginning with the 83B. Do I have that right?
Exactly.
Okay. So that example makes sense for restricted stock, Amy, but what about stock options?
Great question. Let's take another client. Let's use a doctor working in a healthcare startup.
Another specialty of yours, healthcare.
Yep. This doesn't come up quite as often, but let's use Mark as our hypothetical example. Mark receives 20,000 non-qualified stock options at a strike price of $2 a share. His company allows early exercise, meaning he can buy the shares before they technically vest.
Okay.
Okay, so he decides he's going to exercise these shares early while the stock is still valued at $2 a share. And in doing so, he files for an 83B election. So he's saying, I want to pay the taxes on this while these are $2 a share.
Mm-hmm.
So how this helps is by filing the 83B election, he owes zero tax now because he exercised the options at fair market value. So the exercise price and the fair market value of the stock was the same.
So because he bought the stock, it's not treated as income? Do I have that right?
Exactly.
Okay.
So over a few years, the company takes off and the stock is now worth $15 a share.
Mm-hmm.
Because he filed this 83B election early, he only owes capital gains tax when he sells the shares. He isn't going to owe ordinary income tax, which is the norm for non-qualified stock options.
Okay.
So we've actually, in this scenario, changed by filing the 83B election. Not only did we pay taxes early, but we switched him long-term to long-term capital gains rather than ordinary income tax.
Again, preferable tax rate.
Yes.
And so if he hadn't filed, what would that have looked like?
Had he not filed, he would owe income tax on the difference between a strike price, $2 a share, and the value at vesting of $15 a share. So basically, $13 a share difference times the $20,000 shares. That's a huge tax bill.
That's more math than I'm qualified to do without a calculator, but it's big. All right, Amy, off the top, you mentioned that this is not the best idea for everybody. Again, your favorite phrase, it depends. Let me flip it around and ask you, when is an 83B election a bad idea? I mean, it's a great strategy if the stock's expected to grow, but I would imagine it's not always going to make sense.
Well, what I like what you just said is, if the stock is expected to grow, this is where really we want the magic 8 ball that's accurate to tell us what the future holds. So if someone's going to consider making this election, there's 3 major risks to consider. 1, are you going to leave the employer before the stock vests? Because if your shares don't fully vest, you could lose them.
Mm-hmm.
But if you lose those shares, you don't get back the taxes you paid up front.
Okay, I can see where that's a gamble.
So there is some sunk cost that you're choosing to invest, if you will, by paying these taxes up front and filing the 83B election. And so there's dominoes like staying employed that you want to make sure are going to happen.
Mm-hmm.
2, we alluded to, what if this company doesn't do well?
Yeah.
What if the stock doesn't increase in value? Or worse, it declines? Then you've paid taxes again on something that you're not truly benefiting from in the future.
I want to make sure I understand that piece of it. So if the stock was $10 at the beginning and you paid that taxes on the 83B up front at a rate of $10 per share, and it goes down to $5 per share, you've paid the tax at the higher rate. And like you said, there's no benefit.
Exactly.
Okay.
In your example, you would have paid twice the amount of tax you needed to.
Right. Okay.
The other issue is you don't have the cash or you can't afford the upfront tax payment.
Sure.
In our example of 10,000 shares at $1 a share, maybe that's not a big deal. But when we're talking sizable grants, this becomes more likely. And so how do you decide I can't afford this, or should I pull it out of other investments to pay this? That's where we start to have more what if questions, what if scenarios.
You're waiting for the magic 8 ball to say all signs point to yes, but there is no magic 8 ball in this
Exactly.
world. Okay, so now that we've covered the pros and cons, if someone decides an 83B election is right for them, how do they file it?
It's a simple process, but timing is the bugaboo on this. They need to file within 30 days of the stock grant or option exercise, and there's no exceptions to that.
Okay.
Number 2, we have to submit a signed 83B election form to the IRS, usually via certified mail, and provide a copy of that signed 83B election to the employer. And
but wait, there's more.
There's more. That 83B election form also needs to be attached to your tax return for that year.
Okay.
So if I do this in 2025, when I file my 2025 taxes, a signed copy of that 83B election form needs to be attached. The deadline is strict. Missing it means you lose the opportunity to make the election.
Yeah, like
so you could have intended, but if you're at day 31, nope, it's not happening.
Like you said, no take backsies. So if you miss that window, there's no going back.
Yep.
No, or if you're a golfer, no mulligans, we'll put it that way. As we wrap it up, Amy, what are your key takeaways from this discussion on 83Bs?
First, it's just that an 83B election can be a great tax saving strategy if you expect the stock value to increase and you really feel you've got some good job stability. That this strategy reduces your taxable income at vesting and allows for lower capital gains tax rates later. Yep. That's a win. It's not always the right choice, right? We've joked about it depends throughout this episode. There's the risks, it's vesting risk, it's company growth, it's upfront taxes, it's cash flow. All have to be considered before making the election. And then most importantly, that there is a firm deadline.
30 days, as we said earlier. So if you're receiving restricted stock or stock options, 83B elections could be right for you. Again, it depends. Could save you thousands in taxes, but not for everyone. If you have specific questions about 83Bs or anything related to planning your finances, you can always reach out to Amy and her team at Thimbleberry Financial. And how do they best do that, Amy?
They can reach us online at thimbleberryfinancial.com or by giving us a call at 503-610-6510.
All right, good stuff, Amy. We'll talk again in a couple weeks.
Sounds great, Jag.
Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Thimbleberry Financial are not affiliated.